committee. We will call the meeting for February the 1st to order. Senator Dietrich, you have some guests today.
I do. Thank you, Mr. Chair. I have 3 pages with me today from Landon Middle School. I have Isaac Waltner. Hi, Isaac. I have Walter Hageman, and I have Dexter Lonergan. And so they will be with me in one of the most fascinating committees they could ever go to, right?
That is correct.
And we welcome you.
Thanks for being here. Next item on the agenda is bill introductions. I'm not aware of any. Eric? Okay, we will now turn our attention to a hearing on Senate Bill 23, which is eliminating the statutory 15% alternative investment limit for capers. Eileen, you want to give us a bill brief?
Thank you, Mr. Chair. Good morning, committee. Senate Bill 23 amends KSA 74-4921, which is the statute governing the management and investments of the Capers Public Employees Retirement Fund. So under current law, the total of all alternate investments cannot exceed 15% of the total investment assets of the fund. However, the 15% limitation is not considered to have been violated if the total of all such alternative investments exceeds 15% as a result of market forces acting to increase the value. And if that were to occur, the board would not be able to invest or reinvest monies until that total value of the alternative investments drops below the limitation. So Senate Bill 23 would remove the 15% limitation and allow the board to adopt a limitation for the investment of alternative investments expressed as a percentage of the total investment assets of the fund, and the bill would become effective upon publication in the statute book, which would be July 1 of this year. And with that, Mr. Chair, I can stand for questions.
Thank you, Eileen. Are there questions? I see none. Thank you. We will now turn, I guess, to the proponents, or at least staff presentation. Alan Conroy, Executive Director of Capers.
Thank you, Mr. Chairman. Appreciate the opportunity to be here. And this is a proposal from the board. So this is probably the only time during the session that appear before you as a proponent of a bill. Of course, usually it is informational, and we give you information on costs and all those kinds of things. But so this, I am appearing on behalf of the board requesting your support for Senate Bill 23. And usually Jared Waltner's here, but since as Senator we have another Waltner here, so if you have any questions that I can't answer, I'm still going to turn to this Waltner for help with answers. I've also brought our Chief Investment Officer, Bruce Fink. Some of you have heard about the Oracle of Omaha. He's the Oracle of Topeka, or of Capers. And so I'm just going to give a little bit on the history surrounding this limitation on alternative investments, and then Bruce will pick it up from there, and certainly either one of us will be glad to respond to questions. So, I mean, the gist is, as Eileen, of course, stated, there's a statutory cap that alternative investments, which are private equity or infrastructure, and generally those, private equity or things that in broad brush aren't publicly traded, like on the U.S. Stock Exchange. And then infrastructure, which is in our real return asset class, as it's called, but it'd be things like roads and bridges and airport terminals, those power generation, those kinds of things. But the current statute is it can't be more than 15%. And this bill there'd still be a cap, but it would really delegate, the legislature, if you so decide, would delegate that authority to the Board of Trustees for them to establish that cap. And there's a long litany of other requirements or restrictions, I guess, on alternative investments, and Bruce will walk you through those, but all of those remain the same. So the only thing is kind of I guess the policy question is who's going to set the cap on total alternative investments, the legislature in statute or the board. And so, of course, with the volatility in the market, it's kind of that, I guess, that numerator effect. But here, just several months ago, that percent had climbed up to 14, a little over 14%. Now, as with the volatility, we're down to about 13% of the trust fund in these alternative investments. And so there's some issues, again, as Eileen pointed out, there's a possibility we could go over that 15% cap. It doesn't mean we have to sell things, immediately, but it means we can't do any additional investments or reinvestments. And again, Bruce will talk about that. On the top of page 2, in my testimony, just gives you the little bit of the history. Actually, it was first, alternative investments were first defined in 1992. So going way back, and those of you may remember, there was quite a bit in terms of capers, investment difficulties in the early 90s. There was a special investigative committees. There were subpoenas and all kinds of things that went on. And ultimately, out of that, initially following that 1992 session, there was a cap of 10% on the total assets that could go into alternative investments. And then that was revised the next session to 5%. So that worked out fine, but after almost a decade of building out those alternative investments, and again, Bruce can tell you, I mean, it takes a long time to find an investment, to vet it, and then to actually make the investment, and then a lot of times there's quite an investment queue before the money's even drawn. So anyway, we reached about 4.5%. At the end of calendar year 2000. And of course, then the .com bubble came along. And so because of that, again, as the value of the trust fund overall went down, we exceeded that 5% cap back in that. And so, of course, the investments stopped. And so the board then eventually requested that alternative cap be changed from 5% total cap to a 1% cap on annual commitments to alternative investments. And the legislature approved that change, and so we started that process of restarting the alternative investment program. And then in 2012, the system requested another change in that language that would allow net new investments in the alternative investment portfolio up to 5% of the total market of the trust fund. And so the 2012 legislature eventually enacted this change, kept all the other restrictions, and then the legislature at that time also then added the current overall cap of 15% on total alternative investments as a percentage of the overall total investments of the system. So we're at that 15% cap. We're nearing it. It's been in place since 2012, and that's what brings us to that. And so if I may, Mr. Chairman, I'll switch gears and let Bruce Fink, again, our Chief Investment Officer, talk to you kind of about the mechanics and those other restrictions.
Good morning, Mr. Chairman. Good morning, committee members. Alan, thank you again for that introduction. I'll try to live up to my elevated status as Oracle. A very high bar has been set. What I'd like to do is continue Alan's discussion of the alternatives cap, and maybe I'm going to hit on perhaps 2 items. First is the impact of the 15% cap if in fact we were to trigger that level under current statute, then to go through a little bit some of the guide rails or guidelines that are currently in statute that will remain so if the proposal if the proposed bill is passed. So as Alan said, we came very close to exceeding the 15% cap this past summer and fall with the market decline. It's a function of, it's called the denominator effect. If you think about the exposure as defined in statute, it's the market value of the alternative assets as a whole divided by the market value of the total fund. most of the public market assets react much more quickly to declines in the market. Alternative assets are much slower to react. They're valued quarterly, and that reaction to market events is somewhat slower. So as the denominator declines in a market downturn, as it did last year and as it did in 2000, that ratio increases. So that was the events that we saw happening towards the end of last year, the summer and fall of last year. What would happen to the program, the alternatives program, if that level was breached is we would be required to stop all new investments in alternative assets. And currently, we have two strategies that fall under the statutory definition of alternatives, and that's our private equity program and our infrastructure program. So each of those programs, the timeline for making those investments are quite extended, and I think Alan alluded to this a bit. Maybe give you some sense of that. We are looking at possible deals out into 2024 currently. That's how far our pipeline looks out into the future. Current investments that we may be considering have the due diligence working at was probably started 6 to 9 months ago. So you can imagine if we are triggering a 15% cap on Wednesday and dropping below that on Thursday, managing that type of pipeline becomes very difficult. The downside or the risk that introduces into the investment program as a whole is that starting and stopping, our investment program could be on hold for an extended period of time. That would introduce additional risk into the portfolio because we would not be able to diversify across time, and it's called vintage risk, but not being able to or being precluded from diversifying across time introduces additional risk into the portfolio. We experienced that in the 2000 to 2007 timeframe when the entire program was no investments had been made when the cap was breached at that time. So that's one of the outcomes that we're trying to mitigate with the board's proposal. The second is over the last 15 years or so, maybe longer, the system has been able to build some very strong relationships with some very, very successful firms in both private equity and infrastructure. And just the nature of that business, there's a high demand for access to the top-tier funds. If we are out of the market or unable to reinvest with those managers for an extended period of time, we may lose access to those funds. So those are really the two overarching concerns that through the board and the board's recommendation or request, working to mitigate. I guess I'll pause and if there's any questions on that before I get into maybe the guidelines that will remain in place.
Bruce, thank you. Committee, any questions? Senator Pittman?
Thank you, Mr. Chair, and thank you, Bruce. That was an excellent explanation of the need here, and very, very supportive of it, given the flexibility that you need, especially in market downturns like we have with that ratio changing. It makes total sense. Could you elaborate, one, on the infrastructure piece that you mentioned, and then two, could you tell us in your next statement, that you're probably going to talk about it, but how do we make sure we don't get into the situation we were back in 1992 when we first put in these 5% caps without judging how that kind of came about, where maybe some folks had a different idea about what those alternative asset investments might be, and maybe those weren't as advantageous as maybe your strategies are now?
I appreciate it. Yes, thank you. Thank you for that question. On the infrastructure question, as Alan described, infrastructure are investments in roads, bridges, toll roads, assets that are support society's growth and development. Our program, and in fact under private equity, we are not investing directly in a toll road. We hire managers and invest in a fund who in turn invest in these various assets. And the same holds true in the private equity side. We are not making direct investments in property or businesses. And that may take me back to your earlier question. In years past, I think there was some of that activity going on. Many of the guidelines that I'll be going through were put into place to perhaps better define the from the legislature's perspective, and the board is fully in support of these guardrails and as is the investment staff, because they are prudent diversification and pacing rules, if you will, that we follow. So those have been put in place largely in reaction to some of the history. And hopefully that addresses the question. My pleasure.
Mr. Olson.
Thank you, Mr. Chairman. If I recall right, I remember hearing this a lot when I was a young man, that there was very big losses in these alternative investments back in the 90s, and that's probably why they put the guardrails in, because, my question, what kind of due diligence do you do? Are we looking at the same as we would a stock or a bond? Can we, do the background check and make sure someone's not getting sued
Yes.
or there's problems? I just think, we had these guardrails in place for a reason, and I think, as you increase them, you're moving into more riskier environment. That's
Sure.
I guess you're chasing more return, but you're also gaining more risk, and that's something that everybody needs to realize here. As you chase that return, it's not the CD or the bond.
It's not a CD or a bond, yes. I will grant that. Yes, there can be more risk in these types of investments than perhaps public equity. Maybe I'll start with the due diligence process. We have a staff dedicated to private markets, which is where these private equity and infrastructure assets fall. In addition to the dedicated staff, we have an external consultant who also vets these programs. And as you'll see in the testimony provided, one of the requirements is that there's due diligence and we get consultants' recommendations on these as well. So maybe to give you a picture of that process from the consultant and private market staff, the consultant starts, and I picture in my mind, it's portrayed as a giant funnel. They start with a large number of potential investments, and through the consultant's work, we'll bring that down to a much smaller number. We do full due diligence as staff. The consultants do full due diligence independently. So we have the policies and procedures in place, in addition to the guide rails that are in legislation, that have been successful in helping this program grow from where it was maybe 20 or 25 years ago to where it is today. It's a solid program. The policies and procedures that are in place are followed, and the due diligence work is extensive. So your questions about, who is the sponsor? Is there litigation that we need to be concerned about? Have there been losses in the past on previous funds that we need to know about? All that is addressed and vetted through that process.
So, if you don't mind, so your research team, they're looking at every company we have invested. They're reading their quarterly finances. They've done complete background check. Your firm. I'm sorry.
Been
up to date with the financial statements.
So when we're investing in a new fund, we will do that due diligence on the fund and the general partner in the fund. And then as the assets are invested into companies, we are updated and have quarterly, or at least quarterly conversations more frequently about what the underlying investments are and how those are performing.
So the fund's doing the research and then they're telling you, is that?
Yes. Yeah, we are not making investment decisions at a company level within the fund. That's the general partners. These are structured as a limited partnership, so the general partner in that structure is making those decisions, those investment decisions, and we are monitoring those.
Okay, thank you.
You're welcome.
Senator Fagg, and then Senator Pittman.
Thank you, Mr. Chairman. Just looking, I've got a couple questions here. Why doesn't the pie charts show the infrastructure separate from the real estate?
So the pie chart is at the asset class level. Infrastructure is included in the real return slice, which is at about 7 o'clock on that pie chart, the bottom. So within real return, infrastructure is a strategy. So, but infrastructure is specifically defined as an alternatives within statute. So we have a difference between the statutory definition of alternatives and an asset or asset allocation, where we've included the purpose of infrastructure is to advance our real return strategy, which is an inflation adjusted return strategy. And I'd be happy to go into why, but that's where it's housed.
Do we have any other investments that are limited by statutory, or is this the only one?
Infrastructure and private equity are the two current strategies we have in the portfolio that are limited. There are other strategies that are, I'm sorry. Oh, no. There are other strategies that are defined within statute that would be subject to the alternatives limit if we were invested in those strategies.
How many fund managers do you buy for this type of stuff?
I believe we have 33, 34 private equity managers currently, and 3 or 4, I think we have 4 infrastructure.
Okay. One final question, Mr. Chairman. So when you have this many people, do they have a piece, do you examine what's in their portfolio versus what the other ones have to make sure we don't have a piece here and a piece here, but it all adds up to a bigger piece?
Overlap, are you talking about overlap between?
Overlapping with
across, yes, we do try to make sure that we're not investing in doubling up through different fund managers. And I would say on the private equity side, that's probably, I wouldn't say it's never happens, but it's, you know, each of our managers have very specific strategies to invest, and we do diversify across those strategies to try to, in part, minimize some of that. But the larger reason is we want diversified risk across industries and regions and stages of the private equity market, which can range from very early stage to later stage buyouts. So we diversify across all of those through our program.
Senator Pittman.
Just to comment on the discussion you had there with Senator Olson, 92 contrast, maybe we had folks inside of our entities inside the state that were actually doing the investments themselves. Is that a fair statement?
I believe that. I wasn't here in 92, but I believe that was.
And that presents a whole nother set of risks where maybe we don't have the experienced fund managers that we do utilize today, which reduces the amount of potential risk in terms of what we're investing in and gets a better vision, transparency, these types of things, I think, is a contrast between then and now, right? And then on the infrastructure investments, would you say that they introduce inherently more risk, or are they kind of a low-risk investment?
Risk is relative, and I don't mean to evade the question, but no, I think infrastructure, because of the nature of the infrastructure we are invested in, we are invested generally in what's called core infrastructure. There are different, again, stages of infrastructure investment within the infrastructure asset class writ large, from development infrastructure, so think about maybe going out and building something that doesn't exist, to, at the other end of the spectrum, maybe a toll road that has contracted rates going very long into the future. So while they're both infrastructure, a development project, as you might guess, is inherently more risky than that toll road that has long contracted revenues coming in. So we're typically on we are in core infrastructure, and then typically we're looking for those longer contracted revenue streams. So I'll use the analogy, it may not be perfect, but it's almost like a bond-like revenue stream, because you've got that contracted contract for services in place. Obviously, there are other risks that go above bond investing in that, but it's an analogy that might be helpful.
Thanks, that makes sense. And that's part of that alternative investment portfolio that we're talking about.
Yes, infrastructure is part of.
Thank you so much.
Senator Olson, follow up.
Yeah, thank you, Mr. Chair. So, I mean, the infrastructure, you're talking about buildings, though. You're not just talking highways. I mean, there's only so many turnpikes or infrastructure projects.
A building would actually be considered real estate. We have another targeted allocation to real estate, which would include office buildings, apartments, that type of investment. So that is different than infrastructure.
Well, give me a scenario, more scenarios to infrastructure. Is it
Ports could be another power generating facilities.
buildings at ports or not?
It would be the port itself. The fund would have an interest in the port or the power generating facility. So, yes.
Thank you.
Any additional questions? Senator Fagg?
Thank you, Mr. Chairman. You made a comment about when these guys that you build relationships with and you purchase from, that you need to continue making, if they call, that you need to make investments with them. Something to that nature you said earlier in your talk. My question is why on something like that?
Well, I guess maybe to clarify, we don't just, it's called re-upping with the managed re-upping. So if a particular firm had launched their fund number 6 3 years ago, they may be back in the market with fund 7. And if we've been successful with that manager in the past and they have met our expectations in both terms of risk and return, we would be very interested in re-upping with that manager coming in. If that manager had failed to deliver what we expected, we certainly wouldn't invest just to maintain that relationship. And we have opted to not re-up with managers in the portfolio. So even though I don't want to leave the impression that simply because the manager had been invested in the past, they are guaranteed an investment in the future. The same due diligence that we would apply to a new manager, someone we haven't invested in, is applied in re-up situations as well. Now, the 15% cap may cause us to not be able to re-up with a manager we would otherwise want to do because they've been very, very successful, and losing that access or that ability to invest in those very good managers is what we're trying to mitigate.
Bruce, I've got a couple. More comments than questions, and correct me if my comments are incorrect, but you talked about the volatility of the market and the numerator, and if the market goes down, your more traditional investments, then automatically the percentage of alternative investments is going to be higher because the other investments lost value. Is it also safe to assume that if private equity and alternative investments are returning well, then there's growth within that would also add to the percentage?
Absolutely, and that's a very good point. The private equity market's return has been extraordinary over the last 3 to 5 years, and even longer than that. So yes, that's elevating the numerator in that equation as the denominator, the total market value is declining. Yes, thank you. Very good point.
So from a investment decision, if alternative investments are providing very high returns with somewhat of a lower risk, then it makes sense to put more our money in there to maximize our overall total return.
Yes.
I would hate to see what we performed in 2022 if we didn't have private equity and all of our money was in the market. I suspect that loss may have been worse.
Yes, it would have been.
The other question, and it may be better, well, the other point I want to make is we may have to call on Alan, it's even before his time, but my understanding was part of our problem in the 90s was the legislature thought it would be a good idea to use KPERS funds to develop economic development programs in Kansas and to invest in private equity in startups and maybe some risky investments in Kansas. And I think that was part of our problem in the 90s was the legislature thought it'd be a good idea to have us start telling us you where to invest your money. And so reverse guardrails, if you will, but it didn't work out very well.
Yes. Yep. No, that's my understanding. Yeah.
Thank you. You're absolutely correct. And in fact, I staffed in 91 that special investigative committee when I was with Legislative Research, and that's exactly right. There was direction, and the board at that time was involved in trying to use the Capers Trust Fund as a Kansas economic development tool. And this thing, it didn't work out very well. So.
As I say, do you have some additional testimony on guardrails that will stay in place or statutes that will stay in place?
Yes, just another minute or two. The rest of the testimony does deal with the current statutory restrictions on alternatives, and I can move through these quickly, but would be happy to answer any questions you might have. The first four, I would say, are more due diligence related. We need a favorable recommendation, as I discussed, from our consultants for any alternative investment we are taking to the board. Staff is also required to conduct due diligence independent of the consultants. Obviously, they must meet our investment policy statement that the board has promulgated, and the procedures that we have in place. Again, the process that has been put in place over a number of years to make sure that these assets are appropriately vetted and then managed on an ongoing basis. The next bullet, which is bullet 5 in the testimony, is really that limits the annual investment in alternatives to 5% of the total fund. That's a part of the diversification, that pacing and vintage year risk that I discussed a little bit earlier, to impose a guardrail to spread these investments out over time. Then the last three I'll just highlight are all related to different forms of imposing diversification requirements on the alternative investment program. And I'd be happy to go into any additional detail on any of these, but that's a general overview of the guardrails that are in place and will remain in place.
Okay. Bruce, thank you for that. Any additional questions, committee? Senator Fagg?
Thank you, Mr. Chairman, and this comes from my banking background. I don't know how this would pertain. Do you rate shock your portfolio at all? You know, if rates went down 1%, 2%, and how that would affect these type of investments and that kind of thing?
Sure. Great question. We do what we call scenario analysis. So we have a risk system that we model the entire portfolio on and report risk metrics and risk analysis out of that system on at least a quarterly basis. And part of that process is the ability to shock the portfolio using scenarios. We can shock interest rate increases, and in fact, I think we've done some of that in the past. Declines in global equities. On a number of occasions over the years, we've shocked the portfolio in a 20% decline in global equities. Specific to an interest rate shock and how that would impact private equity and infrastructure. Obviously, if interest rates are rising, any future cash flow from an investment is going to be worth less in a higher interest rate environment. So there is going to be some impact. May impact infrastructure a little bit more because of those contracted revenues that I discussed earlier. If there's no inflation adjustment in those contracted revenues, or there might be some impact there. Private equity, I would say less so. But yes, there will be some impact on these types of investments. Hard to quantify without actually running the scenarios, though. Hopefully that helps.
Additional questions, committee? Bruce or Alan, I'm fully supportive of this. We discussed this quite a bit at our joint pensions committee during the interim. Do you have a feel for where the board's at? Should this legislation pass? What kind of cap they might self-impose? Are you looking at, I guess I would prefer to see a hard cap number, but also have the ability of the board to give a temporary relief or So kind of two different caps. Here's our hard cap, but here's where we want to be. But if value exceeds that, then we don't want to pull out of investments or that type of thing.
Yes, thank you for that question. I believe the board will set a cap. I mean, that's our intention. We are concurrent with all of this. We have started our asset liability study, which we do every 3 to 4 years or so. This will help inform what our asset allocation targets are for private equity and infrastructure, as well as the rest of the portfolio. Currently, we're at 13 or 14% exposure on alternatives. So my expectation is that the asset liability study is going to, like private equity, because of the return profile and the risk. So I would expect that we'll be talking to the board about a higher cap than 15%. If that's, if that's 18% or 20 or 22, I guess we'll have that conversation as an outcome of that asset liability study. I would say the board.
That's what I was trying to get at. It's not going to just be an arbitrary number that the board's going to set. There's going to be an asset liability study, and it's going to have data behind the number that's ultimately set.
Will absolutely.
Also the ability to change that number as asset allocation changes.
Absolutely.
Okay. Committee, are there any other questions? Okay. Thank you very much.
My pleasure.
Is there anyone else that would like to testify on Senate Bill 23 as a proponent? Are there any neutrals? Is there anyone that would like to speak in opposition? Seeing none, we will close the hearing on Senate Bill 23. Committee, we are getting ready to get busy. Tomorrow, we are going to work Senate Bills 14, 15, 17. Let me start over. 14, 15, 17, 19, 23, 25, and 26. That's only 7, which is a long way from our record of 12. Yeah. And then next week, we will not meet on Friday. We will not meet on Monday. Next week, on Tuesday, we will hear Senate Bill 85, Senate Bill 44, and Senate Bill 51. On Wednesday, we will hear Senate Bills 34 and 37, and on Thursday, we will hear Senate Bill 104. So, we've got a couple pretty busy 2 or 3 weeks ahead of us. So. Anything else to come before the committee? All right, seeing none, we're adjourned.